So Nancy, great to have you on the show as always. Employment situation on payrolls this morning, a really big miss. Comes after jobless claims that stabilized a little bit. So walk me through your view of the employment situation overall right now.
So the weakness, as you know, was all in the leisure and hospitality component, which is only about 10% of total employment, actually a little less than 10% of total employment. For me, what was most encouraging in the report, this is where you have to really dig into the report and be careful in looking at the headline numbers, was that the Employment Diffusion Index actually remained very elevated at 61%. What does that tell you? Well, that the weakness was indeed in one industry. You had good gains in manufacturing, construction, retail, also in computer employment. These are big drivers of growth for the United States. And within retail, you have quite a decoupling. You've got weakness in department stores, and I call these the dinosaurs of the retail industry, versus you have strength in the superstores, the big Walmart, Targets, where you had very strong employment gains. So it really is important to dig into the number a little bit. Yes, it was big. Yes, it was a big miss. Yes, I was wrong. I expected an increase of 100, and it was down, obviously 140. But within it, it's not as weak as it looks on the surface. And going forward, given now that you do have a vaccine, massive amount of stimulus, and big drivers of growth, manufacturing, construction, technology, healthcare, that at the end of the day, we do think employment gains are going to pick up significantly in 2021, averaging, say, roughly 500,000 per month. I know those sound like big numbers, but you're still going to be below your April peak, even, your March peak in employment with those kinds of numbers. So there's still plenty of labor market slack, plenty of room to heal in the labor market. But net, I think this is a one-off, and the drivers of growth, the stimulus, and the vaccine will all help employment indeed continue to gain momentum in 2021.
So Nancy, it sounds like, not to gloss over, obviously, or to downplay the importance of these job losses, but it sounds like you could describe this as basically kind of being the natural expected result of another strict lockdown, and not necessarily like the existing kind of cracks getting bigger and being irreversible. No,
this was related to the surge in COVID around a very important holiday time, when classically those sectors would be very, very strong. Obviously, they weren't. They were shut down. So seasonal factors also made that sector weaker. And so net, yes, it's not a sign of a weak employment backdrop. It's specifically related to COVID. And therefore, that's where this Employment Diffusion Index is so important at 61%. Now, at the same time, I'm also saying that there is still plenty of labor market slack. I've been listening to your program, and people are concerned about inflation, with average hourly earnings up over 5% on a year-over-year basis. That is not wage inflation. Again, digging into the data, the Employment Cost Index is a better measure of wage inflation, and it's running around 2.5%. Average hourly earnings get screwed up, to be blunt, by industry mix shifts. And the leisure and hospitality sector is indeed the lowest paid wage category within employment. And so when their weight goes down in average hourly earnings, which is what happened, obviously with a sharp drop in employment in that space, you get a surge in average hourly earnings. So this is a mixed shift jump in average hourly earnings. It is not a sign of massive wage inflation. And you see that and when you go through the detail, which I was just doing, on the wage data.
Okay, I like that point, to be very specific about the difference between what we're seeing on the wage inflation, the wage number and the change, versus the actual kind of real inflation of ultimately what people are making and what's making its way into the economy with an inflationary impulse. It's still fairly small. Nancy, when you look at the situation right now that is about kind of this organic recovery that's trying to take hold, and then the stimulus that we're going to put on top of it, and that's already still working its way through the system. I mean, we did just have another stimulus deal that went through. I mean, the checks weren't huge. They were $600, but there was unemployment extension and all of the other important aspects to keep folks' personal incomes elevated as they have been throughout this crisis. Now we're talking $3 trillion on top of it. What did you think about the headline overnight that could be the size of the incoming infrastructure bill by the Biden administration, in addition to the $2,000 checks as promised?
Yeah. So we're expecting additional fiscal stimulus, but nowhere near. It'll be very difficult to get that size of a package through the current makeup of Washington. That's according to my colleagues down in Washington, Andy and Don.
Okay.
We're expecting something roughly maybe 500 billion, 750 billion as a realistic number.
Really? Even post blue wave? Because they got it now.
But the blue wave isn't the blue wave we thought back in November. The blue wave is obviously the House isn't as lopsided towards the Dems as it was thought to be back in November. So blue wave, but it is not a huge blue wave.
Okay.
Plus, let's keep things in perspective. You incrementally perhaps $600 in extra money for individuals isn't a lot. Cumulatively, it is a lot. Personal income in the first quarter is going to surge something over 20%. The saving rate is going to go up to 18% in the first quarter because of all of this stimulus. The consumer is sitting on a pile of cash. Again, it's very important to keep the weakness in the leisure and hospitality industry in perspective. There are still a lot of people working. People are making money. You're sending checks out to people who have jobs. They're probably not going to spend it all. They're probably going to save it. So you're entering the second quarter when potentially the vaccine is going to start to have somewhat of a bigger impact on the healing of the travel and leisure industry. And so we think consumer spending by the second quarter could be increasing 7-8%. Very robust consumer spending, pent-up demand, huge amount of income, high level of savings, generally healthy employment. With this employment diffusion index. So we have 6% GDP growth this year without any additional fiscal stimulus. If we get more fiscal stimulus, we're going to have to raise our GDP outlook.
Nancy, so I think this is such an important message, which is about the still kind of yet to be determined effect of what's already been put into the system. What you're saying is that even without another round, these are the numbers we should expect this quarter. This is Q1. We're here. That we're going to see a big jump in a lot of these important measurements. The last thing I want to get your thought on is from a market perspective on what all this means in terms of some of the directionality we're looking at. And I think maybe the most important one to consider is the dollar, which many have tied to stimulus, whether it was monetary, CARES, the combination of monetary and fiscal that we've seen. Lower dollar has got to be one of the most consensus views out there. Is stimulus on top of what we've already gotten, is that dollar negative? Or if it starts to heat the economy up in a big way, does that come back around and mean we're going to be the best economy on the block, moving the fastest? I mean, isn't that like what traditionally makes the dollar go up?
Yeah, we started to get concerned about the dollar back in August. Not really concerned. I mean, the dollar had a COVID-related spike last spring, last summer. And as COVID concerns started to fade, and as importantly, China started to raise rates, which doesn't really pop up in many conversations, but it's an important driver of the trade-weighted dollar. Combination of easing of COVID concerns and China raising rates was a big contributor to the decline in the dollar we saw starting last summer. Fast forward to where we are today, we still think concerns about COVID are maybe going to also help support the dollar. But more importantly, yes, I think your point is well taken. The U.S. economy is going to end up being one of the strongest in the world, and China is done raising rates. If you look at what they're doing, they're talking about pulling back massive amount of stimulus, but they're done normalizing rates that we think the dollar could actually start to stabilize. Timing of that is very, very difficult to forecast, but right. Yes, we would more towards the bulk of the decline in the dollar is over, and we would start to look for some stability.